Hello, and welcome back to Explain the Charts, your go-to channel for in-depth chart analysis. Today is October 14th, 2025, and we are looking at Bitcoin after one of the most volatile weeks in recent memory. First, we're going to cover the explosive news that rocked the markets, and then we'll dive deep into the charts to see what the data is telling us. The primary catalyst for the recent chaos was the unexpected announcement from President Trump regarding a new 100% tariff on all Chinese goods, set to take effect on November 1st. This move, a response to China's own aggressive export controls, sent shockwaves not just through crypto, but all global risk asset markets. The reaction was immediate and brutal, triggering what many are calling the largest crypto liquidation event on record. Reports indicate that an astounding $19 to $20 billion in leveraged positions were completely wiped out in a single day. This massive deleveraging event followed a period of intense optimism, where Bitcoin had just printed fresh all-time highs above $126,000 in the first week of October. The price plummeted dramatically, with some sources reporting lows near $102,000 in a massive flash crash on October 10th. Amidst this chaos, there are conflicting signals. On one hand, we have retail panic and a massive purge of speculative excess. On the other, institutional conviction seems to remain strong. Spot Bitcoin ETF inflows have been robust, with BlackRock's IBIT continuing to absorb billions. Furthermore, notable Bitcoin bull Michael Saylor's company, Strategy Incorporated, announced another purchase of 220 BTC, reinforcing their long-term accumulation strategy. This creates a fascinating dynamic of retail fear versus institutional buying that we need to analyze on the chart. Let's start by looking at the big picture on the daily chart for BTCUSD. As you can see, the uptrend from September was incredibly strong, culminating in that peak right around $126,000 in early October. Then, we see this massive red candle on October 10th. This is the Tariff reaction candle, and it's a monster with a range of over $20,000. The high for that day was near $122,670, and the low plunged all the way down to $103,310. What's critically important here is the long lower wick on this candle. The price crashed hard but was aggressively bought back up, closing the day much higher at $113,080. This action establishes a major new support level at the low of that crash, right around $102,000 to $103,000. The previous all-time high zone around $126,000 is now the key resistance we need to overcome to resume the bull trend. In the days following the crash, we see the price consolidating and attempting a fragile rebound, struggling to hold gains above the $115,000 level. The volume during the crash was immense, but the volume on these subsequent recovery days has been noticeably lower, suggesting caution in the market. Now, to truly understand the anatomy of this crash, let's zoom into the 15-minute chart, focusing specifically on October 10th. Here you can see the day started relatively stable, trading above $121,000. Then, the selling pressure begins to build before we see this waterfall decline. The price absolutely capitulated in a series of intense red candles, culminating in the flash crash low near $103,310. This kind of rapid, vertical drop is exactly what a massive liquidation cascade looks like on a short-term chart. But notice what happened immediately after the low was hit. Buyers stepped in with immense force, pushing the price back up by several $1,000s in just a matter of an hour or two. This shows significant demand was waiting at those lower levels, likely from institutional players and large whales looking for a discounted entry. The rest of the day was characterized by extreme volatility as the market tried to find its footing after the shock. Switching our view on the 15-minute chart to the last couple of days, from October 12th to now, we can see the character of the market has changed. The extreme volatility has subsided, replaced by a choppy, grinding recovery. We are seeing the price attempt to build a base of support here, largely contained between $110,000 on the low end and about $116,000 on the high end. The price has been making a series of higher lows on this microscale, which is constructive. However, each push towards the $116,000 area has been met with selling pressure. This price action reinforces the fragile rebound narrative we've seen in the news. The market has flushed out the excess leverage, but is now waiting for a new catalyst or direction before committing to a major move. Let's pull back to the daily chart to put this all together and discuss what might happen next. So, what are the reasons to be bullish? First, the massive leverage flush is ultimately a healthy event for a long-term uptrend, as it removes weak hands and resets funding rates. Second, the powerful bounce off the lows indicates that large buyers consider prices near $100,000 to be a strong value zone. Third, the fundamental drivers like persistent ETF inflows haven't gone away. As long as we hold above the key support around $109,000, the bullish structure remains intact for a potential grind back towards the highs. Now for the bearish case. The macroeconomic situation with the US-China trade war is a significant and unpredictable headwind. The rebound from the crash has been on relatively weak volume, which can be a sign of a dead cat bounce before another leg down. The price is currently trapped below the prior support zone of $116,000 to $120,000, which has now flipped to become major resistance. A break below the crash low of $102,000 would be a very bearish signal and could open the door for a much deeper correction towards the $90,000 area. So, let's recap the critical levels and potential scenarios. Key resistance is the old all-time high area of $123,000 to $126,000. Immediate resistance to watch is around $116,000. On the downside, we have initial support at $109,000. The most critical line in the sand for the short term is the flash crash low, around $102,000 to $103,000. I believe there is a 60% chance that the price continues to consolidate and eventually breaks above $116,000, fueled by the underlying institutional demand. This scenario becomes stronger if we see a pickup in volume and positive closes on the daily chart. However, there is a 40% chance that renewed macroeconomic fears or a failure to break resistance leads to a retest of the lows. A daily close below $109,000 would increase the likelihood of this bearish scenario. Things to watch for are any new developments in the US-China trade dispute and the daily spot ETF flow data, which will give us a clue about institutional sentiment. Thank you for joining me for this analysis on Explain the Charts. Remember to do your own research before making any investment decisions. This video is for informational and educational purposes only and is not financial advice.